Welcome to our new IFRS Educational Fund Series. It's an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards (IFRS) through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions of Set 1, to which the answers have been provided on IFRS 7. This is the standard on financial instruments disclosures. Viewers or subscribers have 30 seconds to select or choose the answer to each question. The answers to the 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 1. IFRS 7 also deals with which of the following in reporting certain elements of financial statements? A. Recognition. B. Measurement. C. Classification. D. All of the above. E. None of the above. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 2. IFRS 7 does not apply to which of the following financial instruments? A. Equity method accounted investment. B. Financial assets within the scope of IFRS 9. C. Financial liabilities within the scope of IFRS 9. D. Contracts to buy or sell non-financial items within the scope of IFRS 9. E. None of the above. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 3. Where financial guarantee contracts are not involved, IFRS 7 does not apply to which of the following? A. Insurance contracts as defined in IFRS 17. B. Financial instruments under share-based payment transactions to which IFRS 2 applies. C. Employers' rights and obligations arising from employee benefit plans to which IAS 19 applies. D. Equity instruments as classified by IAS 32. E. All of the above. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 4. For investments in equity instruments designated to be measured at fair value through other comprehensive income, which of the following disclosures is not required? A. The reason for using the presentation alternative. B. The cost of each such investment at the beginning of the reporting period. C. The fair value of each such investment at the end of the reporting period. D. Dividend recognized during the period. E. Any transfers of the cumulative gain or loss within equity during the period. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 5. When an entity reclassifies financial assets in line with IFRS 9, one of these disclosures is not required. A. The date of the reclassification. B. The amount reclassified into a category. C. The amount reclassified out of a category. D. A detailed explanation of the change in the business model. E. The amount of which payment of financial liabilities will be affected. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 6. A compound financial instrument is an instrument A with two or more separate financial instruments, B with more than two separate financial instruments, C that contains both a financial asset and a financial liability, D that contains both a liability and an equity component, E that is wholly convertible into equity. Time counts. 10 seconds gone. 20 seconds gone. 'Up. Question number 7. Which of the following disclosures does not apply when an entity holds a collateral it is permitted to sell or repledge in the absence of default of the owner? A. Disclosure of the fair value of the collateral held. B. Disclosure of whether the entity has an obligation to return it. C. Disclosure of the current amount of the collateral held. D. Disclosure of the fair value of any such collateral sold. E. Disclosure of the terms and conditions associated with the entity's use of the collateral. Time counts. 10 seconds gone. 20 seconds gone. 'Up. Question number 8. Which of the following risks is not specifically stated in IFRS 7? A. Credit risk. B. Liquidity risk. C. Interest rate risk. D. Insurance risk. E. Currency risk. Time counts. 10 seconds gone. 20 seconds gone. 'Up. Question number 9. Which of the following standards is the least complementary to the others in the options? A. IAS 32. B. IFRS 7. C. IFRS 9. D. IFRS 17. E. None of the above. Time counts. 10 seconds gone. 20 seconds gone. 'Up. Question number 10. One of the following is not required to be shown or disclosed when a sensitivity analysis is done for any type of market risk. A. How profit or loss will have been affected. B. How equity will have been affected. C. How cash flow will have been affected. D. The methods used in preparing the sensitivity analysis. E. The assumptions used in preparing the sensitivity analysis. Time counts. 10 seconds gone. 20 seconds gone. 'Up. We proceed to reveal the answers. Question number 1. The answer to question number 1 is E, none of the above. IFRS 7 is purely a disclosure standard that does not deal with recognition, measurement, classification, or specific presentation of elements of financial statements. Generally, the objective of IFRS 7 is to require entities to provide disclosures in their financial statements. The principles in IFRS 7 complement the principles for recognizing, measuring, and presenting financial assets and financial liabilities in IAS 2 financial instruments presentation and IFRS 9 financial instruments. E is the answer to question number 1. Question number 2. The answer to question number 2 is A, equity method accounted investment. IFRS 7 does not apply to financial instruments that are equity method accounted in line with IAS 28 investments in associate and joint ventures and IAS 27 separate financial statements. IFRS 7 does not also apply to interest in subsidiaries that are accounted for in line with IAS 10 consolidated financial statements. However, in cases where interest in associates, joint ventures, or subsidiaries are accounted for using IFRS 9 financial instruments, IFRS 7 applies. This is not the case in this question. A is the answer to question number 2. Question number 3. The answer to question number 3 is E, all of the above. IFRS 7 does not apply to insurance contracts as defined in IFRS 17, especially as financial guarantee contracts to which IFRS 7 may apply under certain circumstances are not involved in this case. IFRS 7 does not apply to financial instruments, contracts, and obligations under share-based payment transactions to which IFRS 2 share-based payments applies. It neither applies to employers' rights and obligations arising from employee benefit plans to which IAS 19 employee benefits applies, nor instruments that are required to be classified as equity instruments in line with IAS 32 financial instruments presentation. E is the answer to question number 3. Question number 4. The answer to question number 4 is B, the cost of each such investment at the beginning of reporting period. All of the options as the answers except for option B are required to be disclosed on investments in equity instruments designated to be measured through other comprehensive income. Disclosure of the cost of investments in equity instruments classified as fair value through other comprehensive income is not required. B is the answer to question number 4. Question number 5. The answer to question number 5 is E, the amount by which payment of financial liabilities will be affected. When an entity reclassifies financial assets in line with IFRS 9, disclosures are required for a detailed explanation of the change in business model, the date of classification, and the amount reclassified into and out of a certain category are required, among others. Disclosure of the amount by which payment of financial liabilities will be affected is not required. E is the answer to question number 5. Question number 6. The answer to question number 6 is D, that contains both a liability and an equity component. A compound financial instrument or a compound instrument is an instrument that contains both a liability and an equity component. No portion of it is a financial asset, and the liability component may be convertible or not. D is the answer to question number 6. Question number 7. The answer to question number 7 is C, disclosure of the current amount of the collateral held. Collateral of a counterparty or another entity is not recognized in the financial statements of a reporting entity, and thus, current amount does not arise in the first place. Disclosure of a collateral's current amount does not hold. Disclosures of all other options as answers are required under IFRS 7. C is the answer to question number 7. Question number 8. The answer to question number 8 is D, insurance risk. Credit risk, liquidity risk, and market risk that is made up of interest rate risk, currency risk, and other price risk are specifically mentioned in IFRS 7. Insurance risk is not mentioned specifically. Insurance risk is the emphasis for the reporting of insurance contracts by an insurer or a reinsurer under IFRS 17 insurance contracts? D is the answer to question number 8. Question number 9. The answer to question number 9 is D, IFRS 17. IFRS 7 financial instruments disclosures complements IAS 32 financial instruments presentation and IFRS 9 financial instruments with respect to financial assets and financial liabilities recognized, measured, and presented in financial statements. While IFRS 17 insurance contracts deals with certain financial guarantee contracts, which can also be reported using IFRS 9 financial instruments, based on some consideration, IFRS 17 is the least complementary to the other standards in the options. D is the answer to question number 9. Question number 10. The answer to question number 10 is C, how cash flow would have been affected. Disclosure required to be made or shown by an entity on sensitivity analysis include all the options as answers except for option C. How cash flow will have been affected by changes in a particular type of market trades that is visibly possible at a date is not required to be disclosed. Disclosure on the associated items of financial statement is limited to the likely impact on profit or loss or equity of changes in the market risk as reasonably possible at a date. C is the answer to question number 10. That is all for this. Thank you for joining us for the part 2 of IFRS 7 Financial Instruments Disclosures. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the series are reserved for OJ Information Limited. Thank you once again and bye for now.